Hi, I'm Kevin Ball from FX Trading Company, and I'd like to continue our look at the euro dollar and the currency pair dollar index. Our first chart, which is a chart that we looked at on the 31st of October, we looked at two counts for the decline in the US dollar. The first on the left with a wave one completed, showing an extended fifth wave, and a second alternate count on the right-hand side, which could have been labelled as an extending third wave, needing a small fourth and fifth wave to complete wave one, at which point we would have moved into a further corrective period to complete wave two. Now, my preferred count to bring this right up to date is the first count on the left. So if we take a look at our second chart for today, this is a chart of the US dollar captured yesterday, being the 14th of November. It shows the same five-wave decline with the extended fifth wave. A Fibonacci retracement has been added, and we're currently at a 50% retracement level of this first wave decline, with what could be labelled as a clear ABC correction. Now remember, we're coming from what is labelled as a B wave high, and you can see the E wave in red completing our B wave high that we've been talking about for literally a number of weeks now. So this first wave decline is shown coming from the completion of that potential B wave high. Now, I just want to have a look at our third chart, which is how this would look in a weekly perspective, again looking at the US dollar. It's not unreasonable now to label this as a completed wave one and two of five of our anticipated C wave decline, which once complete would provide the missing piece to our correction, which started in August 2018. Now remember, we are still correcting the impulse wave in the red box on the left of this chart. Our targets for the completion of this anticipated C wave are shown at the 92.63 and the 91.66 price levels, which is the blue line, which is a 50% retracement of the red box on the left, and the 61.8% retracement, which is the magenta coloured line. But again, we are correcting nothing more than the red box on the left. If we look at our fourth and final chart, this is the currency pair euro US dollar, showing the inverse situation to the dollar index. So the anticipated decline in the dollar would show as a rally in euro dollar. And this chart again shows similar aspects. Again, we have the extended fifth wave, what is labelled as wave one of our five to complete wave C. In this particular chart, we are at a 61.8% retracement of this first wave as of yesterday and today. And you can also see a clear ABC correction. Now, the C wave, incidentally, is 1.618 times the length of the A wave of the ABC correction. That, if you're not familiar, is a Fibonacci confluence point, i.e., the 61.8% retracement level of this first wave decline is equaling 1.618 of wave A of the ABC correction. And as of yesterday, price has rallied from that particular level. Now, as a final point with this chart, if price declines below an exchange rate of 1.08792, then this analysis would be totally flawed. What is labelled as the bottom as the B wave low with a question mark, and the completion of our E wave again would need to be relabelled. So from this particular junction, we'll continue to watch and update, but from this level, if the analysis is correct, you would see a strong rally in euro dollar lasting a number of weeks, and you would see a strong decline in the dollar index lasting a number of weeks. So we'll continue to watch and update and see how this position unfolds.